introduce you to what I think is the exciting science of technical analysis, which does its best to put the probabilities in your favor. Let's define it very quickly. My very simple definition of technical analysis is that it's the study of trends and turning points. The second candle pattern that I want to present is the one that I have most confidence in. Doesn't mean it's going to work all the time, but it stood me in good stead over the years. It's called a bullish engulfing, and the bearish variety is called a bearish engulfing. In this candle pattern, just use your wonderful imagination for a moment. We see 3 red candles coming down the page. In the last red candle, high, low, open and close. The close is below the open, it's shaded red. In the next candle, we see that the close is above the open, it's shaded blue, and very importantly, the body, the blue bit, engulfs the body of the red down candle. What's happened is the market has opened down from the previous day's close and then reversed intraday. This is a very bullish pattern, and I'm showing a couple of examples of it in the next few slides. It stood me in really good stead over the years. There's a bearish version. If you can imagine 3 or 4 blue candles up the page and then a red candle. On the red candle, the body of the red candle completely engulfs the body of the blue candle. That's a very bearish pattern, and the probabilities of the market falling are very high. It works in all time frames, right down till 15 minutes in the Forex market. I found it very useful indeed. Again, it predicts probabilities, not certainties. If you're right 7 times out of 10, you're wrong 3 times out of 10. On the next trade, you don't know whether it's one of the 7 or one of the 3. And later on in the course, I'll be talking about how to think in probabilities. The next candle pattern, they're called piercing lines and dark cloud covers. I haven't got a clue why it's called a piercing line, but if again you can use your imagination, we've got 3 or 4 nice red candles down the page. And then we get a blue candle. Now, the body of the blue candle doesn't quite engulf the red candle. If it had engulfed, it would be a bullish engulfing. But what it does is that it opens down. So the opening price of the blue candle is in fact lower than the closing price of the red candle. And then it reverses intraday and it closes higher than halfway up the body of the red candle. If that's the case, that's called a piercing line. In Chicago forever, it was called a gap and snap, where the market in fact opens down and reverses. There's an Australian who calls it a oops trade, where the market in fact reverses intraday. I've shown a couple of examples of them. I find them again very useful. The piercing line. Now, if you can use your imagination, just have a look. We've got some blue candles up the page. We then get a red candle. On the red candle, it opens higher than on the close of the blue candle. It then reverses intraday and it closes below halfway down the body of the blue candle. If that's the case, that's called a dark cloud cover. It's a very bearish pattern. Again, I've shown a couple of examples of it. I find it very useful indeed.